Good morning and welcome to Bob's Coffee Chat. Today's topic is strategies to help you buy before you sell. Our presenter today is Cari Anderson from Axos Bank. Cari's been in the mortgage business for 26 years. I think she started when she was 10 and has been an account executive with Axos Bank for the past 11 years. Axos has several solutions to help homeowners buy before they sell. So having maximum lending flexibility is really needed in what is currently a very inflexible real estate market. So Cari, how can we buy a new home before we sell our home, sell our departing residence?
Well, thanks, Bob, for having me. And yes, my name is Cari Anderson, and I do work for Axos Bank. I am a wholesale account executive. That means that I work with mortgage loan officers, bankers, brokers, and people like Bob to help clients obtain loans that they just are not able to obtain in traditional jumbo lending. And we all know, well, you may not know, but most jumbo loans are a little bit more difficult and less flexible traditionally than a conforming loan amount, the lower loan amounts. And where we live in the Bay Area, you are usually in jumbo territory in most neighborhoods. So you really have to work with a mortgage professional who knows jumbo lending. And that's where we come in. So we do a lot of things that are, I guess you could call outside of the box. And one of those is our buy before sell options. And we have several actually that we're going to highlight today. If you do have an interest in finding out more, I would definitely suggest reaching out to Bob because I'm not a licensed loan officer, so I can't give clients advice, but obviously we're all here to learn. So I'm definitely going to give you product highlights, and then you can talk to a qualified mortgage loan officer that might be able to help you out going forward. So couple things terminology wise. We have a couple different ways of helping you buy before sell. One is called cross-collateralization. One is called bridge to sale. And the other one is just a regular purchase loan where I'm going to give you a break on your outgoing residence and not worry about the payment on that. And we'll talk about how we do that. But I want to start with cross-collateralization. And for those of you who might not know what that means, it basically means that we're going to make a loan. And usually when you make a loan on a mortgage, you are collateralizing the property you're buying. But with a cross-collateralization loan, we're not only using as collateral the property that you're buying, we're also going to use the property that you are selling. Or, and another option is we could cross-collateralize another property that you have and aren't selling. You might be keeping your departing residence as a rental. You may have a second home with a lot of equity in it, and that might actually be a better property for us to cross-collateralize. Bottom line is cross-collateralization is just helping you get more loan for the value. So if you have one property, you're going to have a better time getting a higher loan amount when you have two properties and you put their values together. So it's basically just taking more than one property, adding up the values of those two properties together and lending based on that. There's one promissory note, but there will be two deeds of trust collateralizing those two properties against the note, okay? Not to get too deep into lending terminology, it just means that we will have a lien on both properties, not just the one that you're buying. And most of these situations do require you to at least have 10% down. A lot of the clients I come across in this market around here usually have anywhere from 10 to 20% down. That's the average of what I see. In some cases, and I know Valerie was saying that she didn't have a down payment right now, or maybe not enough down payment. There are some cases when someone owes very little on their departing residence, and the value of their departing residence is very close to what they're actually going to wind up buying, that less than 10% down can work. It's not an everyday thing. It's a little less common, but it is something to explore with your loan officer. So if you have a property that you actually aren't going to sell, you're going to keep it as a rental, we can actually give you income credit for the market rental value of your departing residence. So if you could rent that residence for $3,000 a month, we'll give you some extra qualifying income based on that. Most of my clients, though, they're selling their departing residence. So with cross-collateralization, obviously they haven't sold the departing residence yet. They don't want to. They've got a lot of equity tied up in that departing residence, and they don't want to have to worry about doing a refinance on that departing residence to get the cash for the down payment. It's like doing two things at once. So that is the cross-collateralization. Now, how do you know if you're a good candidate for this? Like I said, normally the best candidates for this are people who are not buying up significantly. They're not going from a $500,000 property into a $1.5 million property. They're buying fairly lateral, or they're just buying up slightly. And they have excellent equity position in that departing residence. A lot of these clients have owned their home for many, many years, and the appreciation has far exceeded their debt. They've been good about paying it down. They haven't been taking cash out every time they've had an opportunity, so that their equity has grown to be larger than what they owe. That is the best candidate for a cross-collateral loan. And it also allows for you, when you're ready to sell that departing residence, once you've moved into your new property, you've staged it, you're ready to put it on the market, you're ready to sell, we have the ability to allow you to sell that, because we have a lien on that property. So it does require us to release the lien on it for you to sell it, but we will allow you to sell it without paying the entire loan off. We have what's called a cross release plan that our underwriters will put in place before your loan closes, and it outlines very specifically how much you would have to pay the loan down in order for us to release your property and allow you to sell. Usually when that happens, when you sell your cross property, you're ready to sell it, let it go. Usually what happens then is you are in a position to refi into something more long-term. These loans that I do are fixed period ARMs. They're fixed for 5 years, and then they go to an adjustable. But most people who do this have an exit strategy as well. They know when they sell, they're going to be in a much better position with their income and debt ratios. And so they'll probably go and refinance into a 30 or 15-year fix, and whatever they want to get in for the long term. So this is definitely a stepping stone, but it doesn't come with a balloon payment. It is not something that you have X amount of months to sell and refinance. That's the beauty of this. If you did want to keep it for whatever reason, maybe you're doing interest only and you like the interest only payment, when you sell your cross property and your loan gets paid down, your payment goes down if you're only paying interest. So some people want to keep it for, however long they want. So that's the beauty of this. It can become a long-term loan if that is what works for you financially. But there is no prepayment penalty, so there's no problem if you sell in 30 days and then you go and refinance 30 days later. And if you do think that the cross is something that might want to work for you, what you would do is you would provide your loan officer the values of the property you want to buy, the property that you already own. We would need to know how much you already owe on that property that you already own. And we would also need to know how much you have for down payment, if anything, because every bit counts. So if you have at least 10% down, that helps out tremendously. If you don't, we need to know that as well. So those are the 4 key pieces of information that you would need to give your loan officer, and they will ask you for that when you meet with them. So that is a cross-collateral loan. Now, the term cross-collateral and bridge are many, many times used interchangeably, and it's very hard when you've got 2 very different programs that sound almost exactly the same but aren't. So juxtaposing with the cross collateral, our bridge loan does not cross 2 properties. The bridge loan is a short-term loan on a departing listed resident. So let's say you have a property that you're all ready to list, okay? And you need quick cash out because maybe you want to go buy a property cash, like we were just talking about earlier. Maybe this is how some people are able to buy cash, even though they're not filthy rich, right? They had all this money in equity in their departing residence, and they were just simply able to extract it quickly so that they could make the best offer that they got accepted. So with a bridge loan, we do require a minimum loan of $750,000. Okay, so that is a very large loan amount for a lot of people, I understand. But with these loans, it really is on the high end side of things. And there are bridge loans out there that don't require that high of a minimum. And I'm sure Bob will have somebody on here talking about that, maybe next week, maybe next month. But this could work for some people. And the reason why this might be better for your clients is because the rate is a lot lower than traditional bridge financing. It's an interest only payment. It's 6 3/8, so 6.375 interest only, and it is a 12-month balloon. And this is why we want to make sure that this property is going to be listed, if not already listed. It is a 12-month balloon. That means at the end of 12 months, the entire amount is due. We collect 12 months of payments, which is interest only, at close of escrow. We put that money in our bank. We are an FDIC insured, publicly traded bank. And every month we take a month of interest out of that account and pay the note. When the property sells and we get paid off, then that money goes back to the borrower. It's the borrower's money. It was just set aside so that the payments get made on a monthly basis. The maximum loan to value on that is 60%. So that is something to keep in mind, because if you already owe maybe 50% of the value of your house, 60% LTV is not really going to give you a ton to work with. What this works really well for are people who are empty nesters, who have lots and lots of equity, but just don't have a lot of income to support a jumbo loan qualification. This is a great loan because it does not require your income to qualify like a regular loan would. It's really based on the equity in the property and the fact that it is going to be sold very, very quickly. So this could be a great way to help you get, if not 100% of the down payment for your new house, a significant enough portion so that you can get a purchase loan and not have to rely on your departing resident selling first. This is a great way to not have to write a contingent offer, to extract as much equity as you possibly can, and then go out and make an offer. And we do have an option to help people with a purchase loan after they get a bridge loan with us. And the reason why it could be difficult in some cases is because if you haven't sold your departing residence yet, most jumbo lenders are going to say, well, until you have a buyer for your departing residence, we're going to make you qualify with your departing mortgage payment as well as the one you're trying to buy. That's two houses that your income is going to have to carry in most cases, unless you have a buyer that has signed a contract and removed contingencies on your house. We don't require that. You could do a bridge loan and the next day we will fund a purchase loan for you. And even if this house has not quite hit the market yet, if we have a listing agreement on it, we won't count that debt for you to qualify for the purchase loan. So the only property that you have to qualify for with your income is the property that you're buying. Property that you just got cash out on, that debt does not factor into qualifying. And I can't stress enough how useful that is, because there are very, very few lenders out there that will allow this. Most lenders, like I said, need to have a buyer for your departing residence before they will exclude that from qualifying. So this is a really great way. In fact, I do a lot of these in two-step loans. We'll do the bridge loan, and then at the same time, we'll underwrite the purchase loan. And right after the bridge loan funds, the money gets blown into escrow for the purchase loan, and then we fund the purchase loan. So it's not like you have to get this bridge type of loan and then wait a couple weeks for it to sit in your bank and season. None of that is required. So in some cases where the cross collateral doesn't make sense, it might make sense for us to do a bridge loan and then do the departing residence loan. In still other cases, there might be a situation where the bridge loan isn't going to work for us. Because like I said, I have a minimum $750,000 loan amount on that bridge and a max loan to value of 60, which, it's a pretty small box. I'm not going to lie. It's not going to work for everybody. But this is where private money, other banks who offer equity lines, private investors can help your client or you out with getting the cash out that you need on your departing residence first. Like I said, no matter where your down payment came from, if you have a departing residence with only a signed listing agreement in place, I won't count that debt if you come to me for a purchase loan. So sometimes I do cross collaterals. Sometimes I do a bridge loan and then I do the purchase loan after it. And then sometimes I don't do the bridge loan. Sometimes the way that the client gets their down payment has nothing to do with Axos Bank. They find another creative way to get the money that they need for their down payment. And I just come in and say, look, I'll do this purchase loan for you. It's a jumbo loan. You've got another property that hasn't even hit the market yet. You just signed a listing agreement with your agent and you don't even have it on the market yet, let alone have a buyer. That's fine. I don't have to qualify you with that payment. The only payment that I'm concerned with is the payment on your new property. That sometimes is all that you need, and to be perfectly honest with you, in some cases, this is by far the least expensive option, because if you can find, and I always say the number one thing to try is to get an equity line first with a bank. That is going to be, besides borrowing against your own funds, like if you have stocks that you can margin or retirement that you can borrow against, besides those things, a home equity line is usually going to be your cheapest money to get out of your departing residence for your down payment. If for whatever reason you don't have time for that, I get a lot of people come to me, they're already in contract. I'm sure the realtors on this call can relate. They've already made an offer and they don't have time to go to a bank and get an equity line. They need the down payment now. So there's other options. There's gifts from family. We're okay if the entire down payment comes from a gift. That again is another thing that most jumbo lenders do not like. They like you to have at least 5 to 10% of your own funds in the transaction before mom and dad come in and give you anything. We don't care about that. So gift is another great option if you can get it. And then if those things don't work, then yes, there are lots of private money lenders out there that will go in second position behind your first mortgage, okay? The bridge loan I do has to pay off the first mortgage. I don't go in second position. I need to be in first position. So if you have a large enough loan to speak of, then the best option is to try and get a secondary mortgage to get the down payment. And that's where our friends in the private lending industry come in. And I work with several of them and refer them business all the time because I get people who come to me, they want to do a cross collateral for whatever reason, their equity doesn't qualify them or their income doesn't qualify them. And they need to do it this way. They need to get the cash out first. Then they need to come to me for the purchase because all I'm going to qualify them is on their purchase. So it's a little bit of, again, I think we've heard the word strategy a couple of times this morning, but I can't think of a better term for it. You have to strategize with people who know what they're doing, who can look at the numbers in front of them and say, this is what you got to do. I have to say, this is probably one of the things that I do all day long. This is by far not the only product that I work with, but it's a big one. And it is something that I look at most of the day. So I see so many different situations. Everybody's is different. It's like fingerprints. Everybody's is different. So again, I'm going to repeat those 4 things that you need to have your loan officer know. What is your price range? What do you want to buy? What is the house that you're looking in? What is that price range? What is the estimated value of the property that you already own? And your realtor can probably give you that data. How much do you owe against that property? All of the liens on that property, what do you owe? And how much do you have in assets? And that can be stocks, liquid. If you're 59 and a half, your retirement can be liquid. But just give your loan officer as much information as possible, because the more that we know, the more that we can come up with ideas. I have other options that aren't as common as what we just talked about. But here's one that you may have heard of before. It's called pledging assets. And this is banks use this quite a bit. There's a lot of banks out there that'll allow you to borrow more than the bank would normally feel comfortable with if you put some money in their bank and leave it there as, it's just basically a pinky swear that, hey, I'm not going to renege on my note. I'm going to pay you. And just to tell you how much I have behind this, I'm going to put some money in your bank and you can hang on to it until I refinance or sell or pay the loan down low enough that you don't feel like you need to hold this money anymore. So that is one of the things that we can do. And it's kind of like a cross collateral, but instead of cross collateralizing a property, you're cross collateralizing stocks or cash. I would say the majority of deals I do with this, it's people wanting to pledge their stock. They want to leave their stocks and their strategy for investing in place. They don't want to liquidate their stocks. They're doing too well. They don't want to pay capital gains. They want to leave that money there. And this is a way to have that money work for them as actual down payment and collateral against a loan. So instead of us lending 70% of the value, if you pledge X amount in stocks, we can lend up to 90% of the value because we have that extra collateral and we feel good about that. So it's a way of taking your assets and instead of liquidating them for down payment, you're just kind of pledging them as collateral against a higher loan than we would normally lend. And again, if it's in stocks, you can keep trading in that account. It's not frozen. It's just not going to be available for liquidation. That's the difference. So you can still trade. You can sweep the overage over and above the pledge amount. Keep it all in your name. It's just another way of getting a higher loan amount. And it does have to be publicly traded stock. It cannot be private stock. And of course, you can also pledge cash. I have people do that from time to time. Normally, if they have the cash, they're just going to put it down. But sometimes they don't want to. They just want to leave it in the bank and let it sit and then maybe refi in a year and see if they can get it out. So I see that happen as well. And then finally, I want to talk about reverse 1031 exchanges. I know we have some investors, some real estate experts here. This is a great and very little known program that we have. It is very, very difficult to get a mortgage loan on a reverse 1031 exchange. And I won't go into the legal jargon, but basically a reverse 1031 allows an investor to locate and purchase a replacement investment property before selling their current investment property. With a forward exchange, you sell first, then you've got a specific number of days to locate and close on a replacement property. And we all know in a seller's market, that is not the position you want to be in. This flips it on its head and says, okay, you're going to find a new property first, you're going to buy it, and then you have a specific amount of time to sell. No problem. If you can buy first and then sell, you're on definitely the better side of the coin when you get to sell on your time. So this helps definitely usually help people get the price that they want on the house that they're going to sell. Now, this is obviously only for investment properties. It's not for, primary residence. It's for investors who want to buy an investment property before they sell, keep the same tax basis, not pay any capital gains. We will lend up to 60% of the value of the new investment property while it is in the exchange's title. And by that, I mean, you can't have two properties in the borrower's name at the same time. That violates the tax benefit law. So what happens is the exchange accommodator takes temporary title to the new property until the investor sells their old property. And then the investor comes in and takes over the title to the new property so that it meets the IRS tax code. And because of that, most lenders say, no way, we're not going to lend on a property that is owned by an exchange trust. We're not going to do that. We have partnered with a very well-known and well-versed 1031 exchange accommodator who knows what we need to feel comfortable lending, and we know what they need, and we work very well together. So if you have somebody or you are somebody who's looking to do this type of exchange, you'll want to reach out to Next 1031 Exchange Services, and the number's right there. And if you work with them, then we can do the loan to help them acquire the property. I get a lot of questions that, ask if we can do a cross-collateral loan on a reverse 1031, and we really can't because title is in two different entities. The down leg property and the up leg property are owned by two different entities at closing, so we can't cross-collateralize them, but we could do a bridge loan on the old property to get them the cash out that they need to purchase the new property. That's an option. again, you could have the investor go to a private money lender and get the down payment out first. And of course, that property is going to be sold. So we're not going to underwrite the debt on that property. So it kind of, it's very similar to what we do on a cross collateral or other type of buy before sell, but it's within the confines of a 1031 exchange. So I believe that's all I have. And, I wanted to keep it short and sweet because it is very wordy and intense information, and it's very hard to simplify it without taking too much time. I just wanted to give you a little bit of scratching the surface so you kind of have an idea of what it is I do, but I'm sure some people have questions. So if you want to unmute Bob or have people raise their hand, either way, I'm open to questions.
Well, thank you, Cari. Yeah, for sure. We'll open it to questions. I'm going to conclude the recorded portion of our presentation. So thank you, Cari.